The Indian rupee plunged to a record low on Wednesday, breaching the 92 mark for the first time. It closed at 92.15 against the US dollar after hitting an intraday low of 92.30. Well, investors have shifted towards safer assets such as the US dollar, strengthening the greenback and putting pressure on emerging market currencies, including the rupee. So far in financial year 2026, the rupee has depreciated 7.82%, its steepest fall in 3 years. This marks the worst performing major currency over the past month alone. It has weakened nearly 2%, and a major driver behind the rupee's weakness is the surge in crude oil prices. For India, which imports nearly 85% of its crude oil requirements, higher oil prices directly increase the import bill. As oil becomes more expensive, India needs more dollars to pay for energy imports. This increases demand for the US currency and puts additional pressure on the rupee. Rising crude prices also risk widening the current account deficit and fueling inflation. Currency traders said the Reserve Bank of India intervened to curb excessive volatility. However, economists note that the RBI's actions appear calibrated, aimed at moderating the pace of depreciation rather than reversing the trend. In the near term, the rupee is expected to trade in a broad range of 91 to 93. The currency weakness coincides with sharp declines in equity markets. The Sensex fell 1,122 points to an 11-month low, while the Nifty dropped 385 points to 24,480, its lowest closing level in 6 months. Over the past 3 sessions, the Sensex has declined 3.8% and the Nifty nearly 4%. The investor wealth has eroded by roughly $270 billion during this period. Total BSE market capitalization slipped below the $5 trillion mark to $4.85 trillion. The Indian markets performed relatively better than some Asian pairs, and analysts caution that rising oil prices and persistent geopolitical tensions remain key risks for both the rupee and equities in the near term.